Good afternoon, everyone. Thank you for taking some time to attend our session today. We will get started in just about 1 minute. Good afternoon. Once again, thank you for taking time out of your busy afternoon to join us for today's quick tips training session. My name is Jessica Tolles. I am our Vice President of Suburban Property Management here at First Service Residential. I will be leading you through this introductory financial training today. This afternoon, we will be reviewing what novice board members should be looking at in the financial package in order to make informed business decisions for your community. As a reminder, today's session is being recorded. We will be sending out the session to those who've signed up, along with the responses to the questions that we get throughout the session. You'll see on the screen, there is a control box for this platform. If you expand the questions section, you are able to pose questions throughout today's webinar. We encourage you to ask questions. We will answer them towards the end of this session. If for some reason we're unable to get to all of the questions, we will be sending out the entire presentation with the Q&A probably sometime next week once we get it all settled up. We will also have a couple of poll questions, so pay attention. There is a quiz, my friends. Today's agenda, we are going to be reviewing the documents that are included in the standard financial package, what you should be looking for in those documents, and how to make the best decisions for your community. We're going to start with the entire financial package. On the screen, you'll see a list of the reports provided in our standard financial package. Today, we're going to focus on 3 documents that are helpful for board members who may be intimidated by or are new to reading financial statements. We're going to start with the income and expense report. You might be asking, aren't you skipping the balance sheet? Isn't that the first document in your financial package? Yes, your balance sheet is typically the cover page on your financial, but if there's one document you're going to look at as a board member, we encourage you to look at the income and expense report. The income and expense report is a summary of all financial transactions during a given period of time. This document is listed in order of your general ledger account codes, which may be a 4-digit or 5-digit number here in the center of the document. We list them in order by account code with the account description. This document is broken out into 2 time frames. On the left side of the screen, you'll see the current month. This contains your actual expenses or income for the current month, what was projected or budgeted to be spent or earned, and the variance, meaning the difference between the 2. On the right-hand side, you'll see your year-to-date information. This contains your actual expenses or income for the period to date, what was projected or budgeted to be spent or earned, and again, the variances or the differences between the actual and the budget. In both the current month and the year-to-date sections, we break out the variance by both dollar amount and percentage. On the far right, you see we have 2 additional columns for your information. We list your current year's budget so that you're aware of how much overall throughout the year you've budgeted to spend in that line item, as well as how much you have remaining to spend in that line item. Or if you're looking at the income, how much money you have left to earn for the year. In addition to the time periods, this document is broken out into 2 sections, your income and expense, along with a third option. On the first page of the income and expense report, you have your income at the top of the page. The bulk of the report is made up of your expenses, which are broken down into categories such as utilities, building repairs, common area expenses, payroll, etc. This makes it easier for you as a board member to find certain expenses, especially key ones that may be top of mind. Then in between your operating and your reserve expenses, we do have a very important section, the difference between the income and the expense. This is important for you to see your net operating income or loss for both your current month and year to date. On the last page of your income and expense report, we review the reserves. Same layout as the operating, you have your month to date and your year to date information broken out with actual versus your budget and variance numbers. Now, why is this document so helpful? I've zoomed in on the month numbers. Here you see actual versus budget numbers. This helps you identify areas broken out by general ledger account codes where you may be over or under budget. This is important for you to be able to track expenses, you know where your money is going, you're able to see if an invoice that you expected to see got paid or maybe it's delayed. We also have on the right side the year-to-date information. This shows you from the beginning of your fiscal period through the current month, your total spend or income earned. The difference between the two helps you be able to determine if a particular item was a blip in 1 month, maybe a bill that you were expecting in July was paid in August or paid in June. That could be a blip. If you're looking and comparing the information from the month to your year-to-date numbers, you could see maybe it's a systemic trend. Maybe you're seeing expenses or income vary drastically over several months. That could be a sign that there's something bigger going on. As mentioned earlier, in between the operating and the reserve sections of this report, you'll find your NOI, or your net operating income or loss. This is important for board members to keep an eye on. It helps you stay aware of your cash flow and how you're spending your money. We will be discussing cash flow in a few minutes when we look at another important document.
Can you hear it?
Yes, now we have time for a poll.
Right back to the line. Yes, okay. The income and expense report is a great document for the board members to look at each month so they can easily track expenses. Yeah.
Go see your other mother.
Yeah. Well, the other mother has
food.
So she smells nice.
Yeah, exactly.
Yeah, it's all about the food.
Excellent, great job. Everyone got that right. That question was true. The balance sheet is another important document for you as a board member to pay attention to. The balance sheet is a summary of the community's financial position at a specific point in time. That is, it's the financial position of the association on that day at that time. Your balance sheet also has 3 sections. It's broken out into your assets at the top, and then liabilities and fund balance, which could also be known as members' equity. On the screen, I have 2 variations of how the balance sheet is, quote, balanced. You could have assets equal liabilities plus fund balance, or you can reverse the math and assets minus liability equals your fund balance. Starting at the top of your balance sheet, assets are broken out into several categories. cash and investments, which are your adjusted and reconciled bank balances, show your operating account, which is your checking account where we're paying bills out of and your assessment income is going into. You may have several different operating accounts, maybe a money market, and you could have any number of reserve accounts, all of which would be listed here in the cash and investment section. You will also have, though hopefully a low amount, an accounts receivable section. This includes money that other people owe the association, also known as delinquencies. Below your accounts receivable line, you may have potential fixed assets. Your clubhouse, your buildings, those types of structures will not be listed in fixed assets. This will only include possessions based on your declaration, your auditor, etc., that your board of directors could sell without an owner vote. In the middle of the balance sheet, we have liabilities. Liabilities, we want to try and minimize within the association, but there are some liabilities that are an everyday occurrence. Some of these may be accounts payable, which hopefully are just bills that came in towards the end of the month that we're going to be paying at the start of the next month. You could have security deposits or any other funds collected in advance, which could include prepaid assessments. Your assessments are due on the first day of a period, typically a month, and if you receive those assessments on the 27th or the 25th of the preceding month, then you don't own those dollars yet. They don't belong to you. So we list those prepaid assessments as a liability on your financial statement. And this is a 50,000-foot view of the financial statement. So if you have a loan or other complexities, you will have other items listed in this section. Last but not least, at the bottom of your balance sheet, you have your fund balance. The retained earnings for your community are the net operating income or loss year over year for the life of the association. You'll notice we've broken that out for operating and reserve funds, but you also have current profit or loss. There's a number there that we've already seen in today's presentation, $4,469. That number ties back to the income and expense report when we looked at our NOI, or the net operating income, at the bottom of that income and expense report. For the period to date, our net operating income was $4,469. This shows you how all of these reports tie together. We have another poll. We had a split response on this question. For the question, it was which financial document is a summary of all transactions over a specific period of time, typically 1 month. That correct answer is your income and expense report. On every line item within the income and expense report, it shows you all of the transactions that occurred for that general ledger account code over the entire month. Your balance sheet, on the other hand, is a snapshot of the association's financial position on a specific day at a specific time. That's the difference between the two. Our third report that we want to discuss today is our fiscal year actuals. This document is important because it really showcases the cash flow for the association. It breaks out the actual versus the budgeted expenses by month for the entire year. This is also broken down into income and expenses. In much of North America, we have two seasons. We have winter and construction. Construction season is when we spend the majority of our association's annual budget. However, we only get 1/12 of our income each month. Or if you're an HOA or a common interest community association, you could get 1/4 of your assessments at the start of each quarter, or you have an annual assessment. That's very important for us to maintain a reasonable cash flow over the course of the year. So we want you to be familiar with the cash flow for the association. As we're budgeting at the end of the year, we're putting this information in for the coming year. We use this document from your current financials to see spending trends, when utilities are higher or lower during the season, so that we can pull this information forward into the next year to be able to determine what your potential cash flow may be. Some of you may be familiar with your manager suggesting, as you're budgeting, to plan to defer a reserve deposit, perhaps in July or August when you have a lot of expenses, and moving it to November or December when you could make a double payment in order to maintain a positive cash flow in months when you have more spending than the assessment dollars you're actually bringing in. I know the numbers are small, but if you see in the blue box at the bottom of this page, this sample cash flow, it's positive for the first 3 months, which is fairly common. January, February, March, those are months where we don't have a lot of expense, but we typically have more income. So we're able to put money aside for the more expensive months. April, we have $8,000 loss scheduled for that month. So we need to be prepared to see a drop in the cash on hand in April. Then it remains negative until July. We see it even out. So it's $1,000 projected income for the month of July, but then it goes back to negative until we get back to November, December. That's why cash flow is so important. There are times when your cash on hand may get very tight within your association. Planning ahead and being cognizant of when your expenses hit the association is important. It may make sense if you have seal coating, painting, and some other projects that you all want to get done in the summer. Maybe some of them have to be done in May, June, and then another one end of June into July, and then another one August, September, so that you're maintaining an even cash flow and don't have a significant output in 1 month. Now, while we've gone over these 3 key documents, the rest of the reports in your financial statement provide you with additional detail and supporting documentation for the information that is summarized in the first 3 documents. Your aging report is going to show your owner balances with aging on those delinquencies over 30, 60, and 90 days. Your general ledger ties into that account code and the description. If you're looking at your income and expense statement and you want to see what made up that number, you can turn to your general ledger and see the detail that made up the numbers that are summarized in the income and expense statement. Your investment report shows the detail of all of the investment accounts that are listed on your balance sheet. We include the bank reconciliations for both your operating and your reserve accounts. And then we also include your open invoice listing, which would tie back into your accounts payable line, and your AP check history, which shows any paid invoices for the current period. Our last poll for the day Great job, everyone. This question was, which document would you look at to see how much cash you have on hand? The majority of you answered correctly with balance sheet. This was kind of a trick question. Cash on hand is going to include your reserves as well. And I threw an operating statement to try and throw you off. But your operating bank statement still doesn't give you the clearest picture of how much cash you have on hand, because that is unreconciled balances. You want to look at your balance sheet because the balance sheet contains reconciled figures for both your operating and reserve accounts. So the assets section, specifically cash and investments, is going to show you how much cash your association has on hand. Wrapping up, I wanted to review a few financial warning signs that you can be aware of as you're looking at the balance sheet, income and expense report, and the rest of the financial statement. Some things that are important to keep in mind. If you see month over month a steady decline in the amount of cash on hand that is not related to construction season or a spending period in your association, that is a financial warning sign. If you are not able to set aside your monthly reserve deposit and you haven't already made arrangements to defer one because you were looking and planning your cash flow in advance, if you're just not able to do it each month, that's a warning sign. If you see an increase in the amount of bills that the association owes, your accounts payable keeps creeping higher and higher each month, that's a financial warning sign. You're not bringing in enough income to offset your expenses, or you're overspending in categories, and we need to take a look and dig into why. If you see an increase in assessments owed to your association that are not directly related to an economic event or something drastic, that's a financial warning sign. So hopefully today we've been able to show you some areas in the financials, just in those first 3 documents, that you as a board member can look at and see these warning signs and know the overall financial health of your association. Going forward, we want all board members to have an overall sense of awareness of the association's financial position, knowing how to review and read your financial statements. You don't have to be a CPA, but knowing the basics will help you know where the association's money is going and where to see any potential areas of concern. I'm going to go through some of our questions now with one of our property accountants, Jenny Garza. And if we don't have time to get to your question, please note that we will be sending out this session and the full Q&A to all of our registered attendees. Jenny, let's see what we have. We did have a question on what the fund balance is. The fund balance, again, is the, let me go back to the slide in my presentation I have printed out so that I can explain it well. We have the fund balance is at the end of the balance sheet. It's also known as your members' equity. It contains the retained earnings for the association, which are essentially the net operating income or net operating loss for each year over the life of the association. So your balance sheet shows for the past 30 years, 1989, maybe you had a loss. 1990, maybe you had a net operating income. It's the pluses and minuses of all of those transactions year over year totaled in your current financial statement. There's another question, Jenny, if you'd like to handle. Oh, that was actually an audio problem. Is there a guide to how much operating cash an association should have on hand in terms of number of months of operating expenses? Jenny, is there anything from an accounting standpoint that you would like to throw in on that? Jenny, we cannot hear you. Since we can't have Jenny respond, I will go ahead and respond to that. Typically, you want 3 months of operating expenses as cash on hand. That's just there's nothing in the law or anything that says what you should or shouldn't have, but it makes sense to have some contingency fund, some cushion in your operating account. You don't want to be running so razor thin that you as a board or your manager has to decide at the end of the month which invoices to pay and which ones to defer to the next month. So we do recommend that you have 3 months of your operating expenses in your account at all times. And that, again, is an accumulation of the net operating income and net operating loss over the years. That's what provides you with that cushion in your account. We have another question. Is it common for HOAs to have cash or accrual financials? And that's an interesting question. An HOA, a condominium association, any such, the interim monthly financial statements are typically done in a modified format where a portion of the financial is done on a cash basis and the balance is done on accrual. This is an industry standard across the US. There are many states like ours that have laws and statutes that state your year-end financial statement needs to be done in accrual format. So that's when you have your audit, your review, or your compilation done that is taking those interim financial statements that December 31st or the end of your fiscal year and converting them back to that accrual basis financial. I'm going to look for one more question, and then I think we want to wrap this up. We will have the download available with all of the rest of the questions here. There are a couple of more detailed questions, so I'm going to let us answer those as a part of our write-up for everyone. Thank you so much for your time today. We really appreciate you taking the time. Financials are often a dull topic, and I appreciate the time that you took to learn a little bit more this time. We look forward to being able to go into greater detail in future webinars. Please join us next month on April 8th, again at noon, for our next Quick Skills webinar. In April, we'll be talking about managing capital projects, and this event will be presented by Regional Director Eric Ruby. Thank you again for your time. Have a great rest of your week.